Imagine you work 40 hours a week, every week, for an entire year. You wake up early, you stay late, you skip vacations, you sacrifice weekends, and at the end of it all, the government takes a clean slice right off the top before you ever even see your money. No negotiation, no delay, just gone. Now imagine someone else, someone whose name you probably recognize, someone who owns multiple homes, a private jet, a yacht, a venture capital fund, and perhaps a small island paying a lower effective tax rate than you. Not because they're doing anything illegal, not because they have some secret offshore account hidden beneath a fake company name in the Cayman Islands, though some of that certainly exists in other conversations, but because the system, the legitimate, legal, government-approved tax system, was designed in a way that quietly rewards those who already have everything, while asking everything from those who are still trying to get there. That is not a conspiracy theory. That is not political theater. That is the cold, invisible architecture of modern wealth. And today, we are going to walk through it, layer by layer, in a way that nobody in school ever bothered to explain to you. Let's start somewhere simple, because the truth is always hiding inside something that sounds boring. There is a fundamental difference between income and wealth, and that difference is the entire game. When you go to work and receive a paycheck, what you receive is called earned income. The government sees it, taxes it, and takes its percentage before the money ever reaches you. When a billionaire's net worth grows by $4 billion in a single year because the stock price of their company went up, that is not income. That is called an unrealized gain, and here is the stunning part. It is not taxed at all, not at 40%, not at 20%, not at 1%, zero. Because in the eyes of the tax code, a gain only becomes real when you sell the asset. And if you are very, very wealthy, you never have to sell. Think about that for a moment. Think about what it actually means. If you own a painting that you bought for $10,000, and that painting is now worth $10 million, you have not earned anything taxable because you still have the painting. The wealth is real. You could use it as collateral for a loan. You could borrow against it. You could live an extraordinary life funded entirely by that borrowing, and none of it would be income. None of it would be taxed. This is not a loophole in the casual sense of the word. This is the fundamental structure of how assets are treated under the law. And the wealthiest people on the planet have built entire financial lifestyles around this one simple truth. The strategy even has a name among tax attorneys and estate planners. They call it buy, borrow, die. And it is exactly as elegant and ruthless as it sounds. You buy assets, stocks, real estate, businesses, art, private equity. You hold them. You watch them grow. And when you need money to actually live on, to fund the jet, the staff, the real estate portfolio, the political donations, you borrow against those assets. Banks will happily lend you money at a low interest rate when you are putting up $10 billion in stock as collateral. The loan is not income. You never sell the stock. You never trigger the tax. And if the interest on the loan is tied to a business purpose, which the best accountants ensure it is, that interest payment itself becomes a deduction, further reducing whatever taxable income might have existed. You are quite literally being paid to borrow. You spend the borrowed money, you live the life, and the assets keep compounding underneath you like a quiet engine that never stops. And then the third part, you die. This is where the system reveals what might be its most extraordinary feature, the one that shocks people most when they finally understand it. When you die and leave those assets to your heirs, those assets receive what is called a stepped-up basis. That means your heir inherits the stock not at the price you originally paid, not at the $10 per share you bought it for 40 years ago, but at whatever it is worth on the day you died. If you bought stock worth $10 and it is now worth $10,000 per share, every cent of that gain simply evaporates for tax purposes. Your heir could sell the very next day and owe almost nothing, because in the eyes of the law, they did not make a gain. Their cost basis started at the top. The entire lifetime of appreciation, the billions built over decades, passes between generations without a single dollar of capital gains tax being collected. And then the cycle begins again. Now you might be thinking, what about the estate tax? What about the inheritance tax that is supposed to stop this kind of dynastic wealth accumulation? And this is where the story becomes even more layered, because the estate tax, which sounds powerful on paper, has been eroded, adjusted, exempted, and engineered around so thoroughly that for most ultra-wealthy families, it functions more as a suggestion than a rule. The current exemption threshold allows individuals to pass millions of dollars to heirs tax-free before the estate tax even begins to apply, and that threshold has been dramatically expanded over decades of legislative work. Beyond the threshold, the tools to avoid it are numerous and well-established: irrevocable trusts, grant-or-retained annuity trusts, dynasty trusts structured to last for generations, charitable-led trusts designed to eventually leave assets to family members after passing through a philanthropic vehicle. First, these are not secrets whispered in dark rooms. They are taught in law schools. They are services offered openly by major financial institutions. They are entirely legal, and they function beautifully. Let's talk about real estate for a moment, Because the real estate game is its own universe of tax engineering, and it affects not just billionaires, but the merely very wealthy, the business owners, the regional developers, the people who own 30 or 40 properties in ways that most ordinary people have never had explained to them. When you own a building, the tax code allows you to depreciate it. This means that every year, even if the building is rising in value, even if the rents are going up, even if the property is appreciating at a pace that would make any investor weep with joy, the IRS allows you to declare that the building is losing value. You are allowed to write off a portion of the building's cost each year as a theoretical loss, even when it is not a loss at all. This paper loss can then be used to offset real income. In some cases, it can offset so much income that a real estate developer who collects millions in rent ends up showing a taxable loss for the year and pays nothing, or in fact receives a refund. And if you decide to sell that building, if you want to trade up to a bigger property, the tax code offers you something called a 1031 exchange, named after the section of the IRS code that describes it. You sell the property, but instead of taking the cash, which would trigger a tax on the capital gains, you roll the proceeds directly into another property. The gain is deferred, then you depreciate the new property, then you do another exchange, then another, and you continue until you die, at which point you already know what happens. The stepped-up basis arrives like a quiet benediction, wiping away every deferred gain in the portfolio your family inherits. An entire lifetime of real estate appreciation, built on land and buildings that ordinary people rent from you, passing between generations without the capital gains tax that a working person would face if they sold a single stock for a modest profit. Now here's where this story connects to something even larger, something that affects every single person alive, including those who will never own a stock or a building or a piece of anything. There is an institution that most people have heard of, but few people truly understand: the central bank. In the United States, it is called the Federal Reserve. In other countries, it goes by different names, but the mechanism is essentially the same everywhere. The central bank has the ability to create money not by printing physical bills, though that is one way people visualize it, but by adding numbers to digital accounts. By purchasing government bonds, by expanding the monetary supply in ways that ripple outward into the entire economy. And this mechanism, which sounds technical and distant, has a very real and very personal effect on the life of every working person on the planet. When more money is created, the money that already exists becomes worth slightly less. This is inflation, the slow, quiet erosion of purchasing power that most people experience, not as an economic theory, but as a feeling. The feeling of going to the grocery store and being surprised. The feeling of looking at a rental listing and thinking something must be wrong with the number. The feeling of realizing that the salary raise you received barely kept pace with rising costs, that you are running harder just to stay in the same place. Inflation is, in a very real sense, a tax. But it is a tax that nobody votes on, nobody debates in Congress, and nobody sends you a bill for. It is simply applied, quietly, to the purchasing power of every dollar you have saved. Now here's the critical insight. Inflation does not affect everyone the same way. When the money supply expands and prices rise, people who hold their wealth in cash, in savings accounts, in checking accounts, in money stuffed under a mattress lose. Their dollars buy less, their savings deteriorate. But people who hold their wealth in assets and stocks, in real estate, in businesses, in art, in anything that has a real-world value that rises with inflation, those people gain. The value of their assets goes up precisely because the purchasing power of the currency they are priced in is going down. Inflation is, in this sense, a quiet redistribution of purchasing power from those who save in cash to those who own things. And who owns the most things? These same people who have the most sophisticated tax strategies, the most powerful accountants, and the most political influence over the very system generating the inflation in the first place. This is not coincidence. This is not accident. This is not a conspiracy in the shadowy sense. It requires no secret meetings, no coordinated villainy. It is simply the natural consequence of a system that rewards asset ownership and penalizes cash holding, administered by institutions whose policy decisions are influenced, directly and indirectly, by the wealthiest participants in the economy. When interest rates are kept low for years at a time, which has been the dominant policy of central banks across the developed world for much of the past 2 decades, borrowing becomes cheap. And who benefits most from cheap borrowing? People with assets to borrow against. People with the balance sheets that make banks eager to lend. The billionaire, using the buy, borrow, die strategy, borrows at historically low rates, uses the proceeds to live and reinvest, while the savings of working people and ordinary bank accounts earn almost nothing in return. The system, in this moment, actively transfers value from savers to asset owners, dressed up in the neutral language of monetary policy. Let's talk about carried interest, because no serious conversation about billionaire tax strategies is complete without it. And yet it remains one of the most misunderstood and under-discussed features of the tax code. When a private equity manager or a hedge fund manager runs a fund that generates returns for investors, They receive a portion of those returns as compensation, typically 20% of the profits. Logically, this compensation money paid to someone for their work, for their expertise, for managing other people's money, would seem to be income, work performed, wages earned, taxed accordingly. But under current law, the carried interest is treated as a capital gain rather than ordinary income, meaning it is taxed at the lower capital gains rate rather than the top marginal income tax rate that a high-earning salaried professional would face. The hedge fund manager who earns $50 million in carried interest pays a significantly lower rate on that $50 million than a surgeon or a corporate executive, earning even a fraction of that amount in salary. This rule has survived repeated attempts at reform across administrations of both parties. It is defended with sophisticated economic arguments about risk and investment incentive. But stripped of the jargon, what it does is straightforward. It allows some of the most financially sophisticated and highest compensated people in the world to classify their labor income as investment income and pay less tax as a result. The conversation about billionaire philanthropy must also be part of this picture, not because generosity is a bad thing, but because the financial architecture of large-scale charitable giving is far more complex and far more financially beneficial to the giver than most people realize. When an ultra-wealthy individual donates appreciated stock to a charitable foundation, they receive a tax deduction for the full market value of that stock. They never pay capital gains tax on the appreciation. And the foundation, if it is a private foundation they control, is now a tax-exempt vehicle they have enormous influence over, including the ability to pay salaries to family members who work there, to fund causes that align with their business interests, to receive favorable press and public admiration, and to make grants on a timeline that serves their purposes. The giving is real. The good it does in the world is real. But the tax benefit is also real, substantial, and primarily available at a scale that ordinary people never access. A teacher who donates $200 to a local charity gets a modest deduction. A billionaire who donates $200 million in appreciated stock eliminates a massive capital gains bill while maintaining influence over how that money is deployed for decades. Generosity and strategy, in this world, are rarely entirely separate. Opportunity zones are another chapter worth reading. Created as part of recent tax legislation, opportunity zones are designated low-income areas where investors can place capital gains into special funds and receive remarkable tax benefits, deferral of existing gains, reduction of those gains over time, and in some cases complete elimination of tax on new gains if the investment is held long enough. The stated purpose was economic development in struggling communities. The actual effect, as documented by investigative journalists and policy researchers, has been significantly different in many cases, with large investments flowing into areas that were already developing, into luxury hotels and high-end real estate that served wealthy newcomers rather than existing residents, with the tax benefits flowing primarily to wealthy investors. The mechanism designed to help the forgotten redirected significant capital toward those who needed no help at all, and did so with the full blessing of the law. And perhaps most invisibly of all, there is the simple, staggering power of time and compounding, turbocharged by tax deferral. When an ordinary person invests in a taxable brokerage account and earns a return, they owe taxes on dividends and on gains when they sell. When a billionaire holds appreciated assets indefinitely, those assets compound on the full pre-tax amount, year after year after year. The mathematical difference, over decades, is not modest. It is enormous. Every dollar that would have gone to taxes instead stays in the investment, earns returns of its own, and compounds further. Tax deferral is, in the language of finance, equivalent to receiving an interest-free loan from the government for the amount of the deferred tax, and the longer the deferral, the more valuable that loan becomes. For someone investing across a 50-year horizon, the ability to defer taxes indefinitely is not a minor advantage. It is the engine of dynastic wealth creation. What does all of this actually mean for you? Not in the abstract, not in the theoretical space of policy debate, but right now, in your actual life? It means that the system generating the cost of living increases you are experiencing, the housing prices that feel impossible, the grocery bills that creep higher without explanation, that same system is simultaneously allowing the people at the very top to grow wealthier at a pace that is, mathematically, accelerating away from everyone else. It is not simply that they are richer, it is that the gap is widening by design, through mechanisms embedded in the legal code, administered by institutions, and largely invisible to the people most affected by them. You were never meant to fully understand this. The complexity itself serves a function. When a system is difficult enough to understand, people stop trying to understand it. They blame themselves for their financial struggles, instead of examining the architecture of the system producing those struggles. This is not about envy. This is not about demanding that success be punished or that ambition be capped. Some of the people who benefit from these structures also created extraordinary things. Companies that changed how we communicate, platforms that connected the world, products that improve lives in measurable ways. Wealth, in many cases, reflects genuine value creation. But the tax strategies that preserve and multiply that wealth have almost nothing to do with the value that was created. They are purely structural advantages that are available at a meaningful scale only to those who already have so much that they can afford the lawyers, the accountants, the trust structures, and the political relationships required to access them. But the game is not rigged in the sense that everyone who tries will fail. The game is rigged in the sense that the rules themselves favor a very specific kind of player, and were largely written by or for that player. There is something deeply psychological about the way the system sustains itself. Most people understand, on some intuitive level, that the very wealthy pay less in taxes proportionally than they should. It generates frustration, resentment, the occasional viral social media post. But the frustration rarely converts into anything lasting, because the complexity of the mechanisms makes them feel unreal, untouchable, beyond the reach of ordinary understanding. When something is too complicated, the mind retreats to simpler explanations, luck, talent, connections, and moves on. This system survives not because it is hidden, but because it is sufficiently complex that most people cannot hold the full picture in their minds long enough to act on it. The information has always been available, buried in tax codes, subsections, and financial planning guides and law review articles that almost nobody reads. The protection was never secrecy. The protection was density. But here's the shift that is beginning to happen, quietly, across the world. More people are starting to connect the dots. More journalists are documenting these strategies in plain language. More researchers are quantifying the gap between the effective tax rates of the ultra-wealthy and those of working professionals. More people sitting at kitchen tables looking at their bills are beginning to ask not just why things cost so much, but how the system that governs money actually works. Who benefits from it? Who designed it? And what would have to change for it to function differently? These questions are not comfortable questions. They do not have easy answers. And anyone who tells you they do is probably selling you something. But they are the right questions. They are the questions that adults in a democracy are supposed to be asking. The most powerful thing about understanding this system is not rage. It is not despair. It is clarity. When you understand why something works the way it does, you can make better decisions within that system, while also, if you choose, participating in the broader conversation about whether that system should remain unchanged. You can understand why owning assets matters in an inflationary world. You can understand why the step-up in basis makes certain financial strategies rational. You can understand why building passive income streams behaves so differently, under the law, than earning a salary. And you can use that understanding in whatever ways are available to you. Knowledge does not guarantee equality of outcome, but ignorance guarantees that you play the game without ever being told the rules. So the next time you see a headline about a billionaire paying less in taxes than their secretary, a phenomenon that famously prompted Warren Buffett himself to describe his own tax situation with some degree of discomfort, understand that it is not an accident. It is not an oversight that legislators simply forgot to correct. It is the predictable output of a system built over decades, adjusted through thousands of legislative decisions, shaped by the lobbying of industries with enormous resources and the drafting of tax code language by people who often return afterward to the private sector firms they once regulated. It is a system that operates in plain sight, in a language most people are never taught to read, producing outcomes that feel unfair precisely because, on some level, they are. Money is not neutral. The rules that govern money are not neutral. The institutions that create and manage money are not neutral. And understanding that, really sitting with it, letting it rearrange the way you see the world is not the end of something. It is the beginning. The beginning of asking better questions. The beginning of making sharper decisions. The beginning of seeing the financial world not as a mysterious force that happens to you, but as a set of structures, built by people, that can be understood, navigated, and yes, eventually changed. Not through despair. Not through cynicism. But through exactly the kind of chloride patient understanding that the complexity of this system was designed to prevent you from ever achieving. You now know more than they assumed you would. What you do with that is entirely up to you.